And welcome back to another exciting episode of The Road to Financial Independence. I'm your host, Mike Riskin, president of CPS Investment Advisors. And as always, I'm joined by my partner, co-host, CEO of CPS, Peter Galacco. Hey, Pete.
Hey, Mike, how you doing?
Doing terrific. How are you today?
I'm doing great.
In today's topic, we're going to be talking about the third quarter 2025 market update.
Can you believe it's the third quarter? The end of the third quarter?
I cannot believe it. The Halloween scenarios are out on the houses, and I think I even started seeing some Christmas stuff in some of the stores.
Well, it's coming.
It's coming. It's coming.
Jeez.
TikTok, my goodness.
Here it is.
The year has certainly flown by. I remember sitting here at the beginning of the year, discussing what 2025 might look like and have some predictions. We had some predictions.
And I don't think we were wrong. We weren't too far off.
We weren't. We're actually fairly close on a lot of our predictions, which is pretty incredible because
that's hard to do.
It is very, especially, looking back and thinking about first quarter and early second quarter, and we had the tariff tantrum, as a lot of folks like to call it. We had sort of that huge down spike, and then of course things have recovered pretty nicely since then in terms of markets and the economy.
I think if you look back at our podcast throughout the year, you'll see that every time there was a market problem, it was more emotional than anything.
That's right.
So in the beginning of the year, before the beginning of the year, I knew this would be an emotional year. We got a president coming in that most of the part of the country doesn't like his policies. We knew there would be some pushback, but I think what Americans realized is we've been letting politics run how we invest our money.
A lot of people do that. Yep.
Doesn't work.
Yeah, that's right.
Politics, it has nothing to do with the economy or in the investment arena, other than making you scared to do the wrong things.
That's right. And one of the truths out there is that the markets definitely hate uncertainty.
Yes, they do.
And so I think some of the themes with this with President Trump, in the sense of as we saw just recently, one text can really send the market in either direction.
Yes, it can.
And he is prone to doing that.
Yep.
And so I think, in terms of market volatility, I think maybe you see a little bit, I want to say more ups and downs, because really when you look at the data, it hasn't been more ups and downs than historically. It just seems.
But it feels like it.
It feels like it.
Because they're bigger swings, because when you're dealing with a 2% decrease or an increase in the market when the Dow's at 4,000,
right,
rather
versus
than
45,000.
right.
That
those numbers become a lot bigger. But I think what's happening is everybody's used to seeing those numbers now, and they're not as scary.
Right.
They really aren't.
Yeah.
And we're starting to see investors kind of step back and say, you know what, all this noise up in Washington, we're not going to let it bother us.
Right.
I think we're seeing that right now. And I know we got a slide. I'd like to talk about that slide right now. What the economy and the markets do during government shutdowns. Right now, we're in the process of having, from what I understand, having one of the longest government shutdowns.
That's right. And as of the taping of this podcast, it still has not been resolved.
There's not.
And we're about 3 weeks into it. Yeah.
It's not even close. They're so far apart, and neither side wants to talk. And what we're dealing with is just an extension for a few more weeks to get to the end of the year, so they can do a new budget.
That's right.
But now we're shut down. And in the past, if you take a look, we've had a number of shutdowns in the past. And the chart up on the screen right now, I'll show you the first one in November of 1981. The market didn't do very well. All right. September of 82, it did okay. There really wasn't any great performance in the times where the government was shut down. But right now it is.
Right.
Right now it's doing very well.
That's right.
In December of 2018, it did very well.
Right.
Why? Because we had a robust economy. We had a great unemployment. Unemployment was way down. People were excited about their jobs. Of course, in 2018, Trump was in the office at that time.
That's right.
So when that happened, people just kept on going about their business. They knew with having somebody like the president in office, there's going to be fighting. There's going to be stuff going on. But in reality, this always wraps up and moves forward. All right.
You know what else this tells me is that when sometimes bad news, people get numb to it if it happens too often.
Oh, this is exactly it.
Right, because people know, the government shut down, and before it would create a lot of fear and panic.
Yep.
But at the end of the day, we know the government is going to reopen. Fortunately, those workers will get back pay, and maybe the government's already reopened at the time of the airing of this.
Right.
And so the point is that I think investors have really ignored that noise for the
They
most
have.
part and say, look, this in particular is not going to affect whether these Fortune 500 companies are going to make money or not.
Right. And looking back, there's a shutdown in October of 1990. Now I remember that. That was the year I graduated from college. I just dated myself, so I'm sorry. But 1990 was the first Gulf War. We were in a pretty bad recession at that
That's
time.
very bad. Yeah.
All right. The confidence in America was not great. There weren't jobs to be had. Unemployment was high. And we were coming off a year that we did 30% in the stock market. Now we're down 3
Right.
or 4, and it's pretty bad. And I expect markets to do that because when people don't feel good,
That's right.
then that's a reason to do that. But when you go to 2018 and current right now, people don't feel that bad.
Right.
The government shutdown isn't going to affect most Americans' earnings. It'll affect some because some people lose their job in the government, but private sector will absorb those jobs.
I think so. Yeah. Especially with the way the job market's
Right.
shaping up right now.
So I don't think this shutdown, regardless of how long it goes. Now, the government's losing money. I mean, we're losing money because of trade and all that and everything going on with the government being shut down. But once we get it back and going, it's going to be robust again.
Right.
People are going to get their back pay. Those that continue to work for the government, and I think everything will be fine. But you're right. It's people are desensitized to the bad news on TV.
Right.
It's all bad.
Yeah.
And when they look at the stock market continue to go up, at some point they step back and say, really?
Right.
Is it really that bad?
Right. Yeah. And I remember growing up also, anytime there was some type of issue in the Middle East, remember oil would just go crazy.
Oh,
The
absolutely.
market would tank.
Yep.
And nowadays it seems like
Well, U.S. pumps more oil than any
so
other
that's
country
definitely
out
changed the
there.
dynamic
So
for
it's
sure.
changed a lot.
Yeah.
So we're not really at the whims of OPEC.
Right.
Countries that don't like us.
Right.
So now oil doesn't go up and
Those
down
types
as
of oil
much.
shocks. Yeah.
Right. Last time we had a real bad oil problem was in 2020 when people stopped using oil. That's when the oil price went down. But spiking up to $100, $150 a barrel, I'm not sure that's going to happen unless we have a real bad problem.
Right. So that's more normalized.
right.
For
It's
sure.
more normalized right now.
Yeah. Well, thanks, Pete. That's a great way to kick it off in terms of headlines and what's going out there. Another headline that we've seen over the last few weeks and end of the third quarter, heading into the fourth quarter here, was the Fed. Of course, the Fed finally cutting rates. It's something that I think a lot of folks have been anticipating for a while, and that finally happened with the Fed lowering a quarter point. And just as a reminder to our viewers in terms of what the Fed dual mandate is, price stability, right? And so certainly making sure inflation is under control, and the second being full employment, making sure that checking those unemployment numbers and making sure the U.S. is fully employed. So let's start with the first mandate, so to speak, in terms of where the rates are and maybe some of what they were looking at in terms of inflation. It seems like inflation has gotten a little bit more under control, and where the Fed fund rate is right now.
Right. Inflation's under control right now.
Right now, right?
We don't, because we have an economy that's doing very well. And don't get all mad at the Fed. That's got to be a horribly hard job because they've got to be able to figure out when to lower interest rates so that bad things don't happen.
I never thought I'd hear you say "Don't get mad at the Fed."
Don't get mad at Fed. I'm mad at Fed. I get mad at Fed enough for everybody. But it's just a tough situation. Now, if I was running the Fed, I probably would have lowered it in the first or second quarter when things were pretty bad.
Right.
That way I can get it in there. Nobody really feels it, but everybody's watching the rates right now. It doesn't appear like it's doing anything at all to inflation, which is a good thing, which means that they could lower it again. They think they're going to lower it a couple more times this year. They promise that. I would hope that they wait till next year to do it. Let's let this settle in and make sure that things don't heat up a little bit too much. But they gave us a quarter of a point. And that's normal. If they gave us 50 basis points, that meant that they thought there was a problem.
Right. And mostly a problem with the employment picture.
Absolutely. Because inflation's staying where it is, but if they see unemployment going up, that could be an issue. And if they lower interest rates too much, then they're not handling both of their mandates.
That's right.
Only one. So they got to be very careful. The next raise, I expect another quarter of a point.
In terms of a quarter point decrease.
Yeah. Not raise, it's a quarter point decrease. When they start getting the 50% decrease, that means that they're very comfortable with the direction of insurance of
Inflation, yeah.
inflation, very comfortable with the direction of interest rates. So that's good. But right now would be a horrible time to do it because nobody's really comfortable where it's going.
That's right. Yeah.
So
And I've heard you say a million times, and we've read this a lot in the financial media in terms of the Fed always seems to be late in either. They're always late to lower, and they're always late to raise them when need to. And
well, it's just like, a lot like investing in the stock market. Most people are late to buy in.
right,
They buy in when the stock goes way too high, and they're late to sell out.
Right.
So they're always, and it's an emotional thing, and you could do a really bad thing if you don't wait. What happens if they went too fast and caused another problem?
No,
Then they'd be backtracking.
right.
So waiting is good. My opinion should have been in a little more rocky situation, so we wouldn't even have noticed this happening. When they were talking about tariffs, oh, they lowered interest rates. Nobody ever even paid attention. They could have done it a couple more times, but here we are. I'm hoping that interest rates will start coming down a little bit. I think your mortgage rates will end up anywhere between 5 and 6%. Don't expect mortgage rates to go down a lot more than that.
Yeah.
I think that's a normal rate. So a lot of people are watching these interest rates, hoping that they can refinance and get lower rates.
Sure. I know that'd certainly be beneficial for the housing markets out there that have slowed down. On the second part of that mandate, I think some of the data the Fed has looked at is on the employment side, and certainly I think when you look at if you just look at the raw number, the unemployment number itself, it's still in a very healthy range of 4.3%. But what the Fed is seeing is a slight uptick from where we were. And I think for the first time since 2017, there's actually more job seekers than job openings.
Yep.
And so finding, marrying up the right job seekers to the right job. So, I think we've had the struggle has been very real over the last 3-4 years, finding the right qualified people. Certainly here at CPS, we're blessed to have had the right people.
It's been the last 10 years.
But last 10, yeah. I mean, there's been so many openings out there versus how many people are looking, and that gap has narrowed to a more normal range, but certainly not quite the job market for seekers out there that it was the last decade.
But do you see the direction it's going?
Well, exactly. Yeah.
So that's something that we need to keep an eye on.
Yep.
And what concerned me a little bit was the person who compiled this data was terminated. And I'm hoping that they get somebody in there a little bit better, because there was an adjustment a couple years ago or last year of
Seemed
a
like
million
some
jobs,
big adjustments, yeah.
really big. And having that big of an adjustment when you're investing people's money going forward and you're watching this as a catalyst,
Right.
and they're lying to you, that's not a good thing. Right. So, I expect unemployment to tick up a little bit, but I don't think it's going to get out of whack. The only problem is, consumer confidence. I think we're going to get into a little bit of that consumer confidence, but you want to talk about it now? I'm ready to go.
Yeah, well, we can. I think we'll get to it in a second. Just one last item. I think just discussing inflation and unemployment. I think one of the other key factors is wage growth. So again, we discuss all the time. People, in order for the economy to grow, people need to spend money, and that's really the engine behind our economy. And so that's why it's so important for employment numbers. The other and marrying those two, it's like, okay, we may have been fully employed the last few years, but inflation was so horrible that even if we're fully employed, those folks maybe 2-3% raises versus inflation that over the last 5 years we're over 30% aggregate. So you're actually losing money even if you're raised. So how are we doing on wage growth, and have we seen an uptick in that?
Wage growth is pretty good. It's better than inflation.
Right. It's back to being over inflation.
It's back to being over inflation. And we all lived through that.
Right.
We all lived through the period of time where inflation was far outpacing our wage growth, which meant that, and it's still far outpaced our wage growth. We're still trying to catch up.
Right.
Okay. So what we were able to buy prior to 2020, we're still not there yet.
Yeah.
Okay.
And probably, with many things, it's probably, we're not getting back to that.
Right. So, when we look at wage growth, first thing we want to do is we want to make sure that the growth is above inflation. Now, in my working years, there's very few times that growth was not above inflation. I started working after the 80s when it was very inflationary.
Oh, right, yeah.
So, we've had a long period of time in the US where when you went to work and every year you got a raise, it was more than inflation.
Right.
Where we started running into a problem was when around 2010, when the ACA came out, the Affordable Care Act. And what that did was that increased everybody's premiums dramatically. That's one of the periods I remember where wage growth did not increase with inflation at the time, but it caught up pretty quick because that inflation didn't continue.
Right.
All right. But you come up on 2020, we had 4 years of backwards growth.
Absolutely.
And right now we're above it. We want to keep inflation low so that the wage growth doesn't get out of hand again.
Yeah.
When you're having to give people 10% raises a year, that's not a good way to run a business, because a lot of times you can't increase your
Right.
goods by that much to cover that cost. So this is a good period we're in. Low inflation, wage growth going up. We got interest rates coming down. So it's a pretty good time.
Yeah, I saw an interesting presentation recently from the CEO of SHRM, which is their national HR group, and they gather a lot of data on this type of stuff. And he was saying there was, back about 10 years ago, he had given this example of Taco Bell of all things, but you get like this 2 burrito deal thing for like $2.80. And recently, I think the same meal costs like over $8
I know.
for the same thing. And then he also said, back then, the average wage for a fast food worker was sitting right around $8 an hour. And the next stat shocked me, because the current average fast food worker with benefits and all that is now over $18 an hour.
And you wonder why Taco Bell costs more.
Correct.
All of the costs went up. So if your store has a dramatic increase in costs like that, plus you got to understand all your producers of the food and all your suppliers had to increase costs because, during that 4-year period in the early 20s, we had huge inflation. People couldn't live.
Right.
So once all those wages go up, nothing comes down.
Right. Exactly.
So now, that the $18 is what you're going to be paying.
That's right. That's right. And that's where technology and innovation comes into play to, figure out, are there ways to not have to hire quite as many people and really more of those high skilled
right.
type
Yeah,
jobs.
you go to McDonald's now and you see a bunch of kiosks.
Right.
It's rarely you see anybody up at the counter ordering, and they've had few people. So, they're running with less people.
Right.
That's not the greatest thing for the economy.
No, exactly.
Keep costs down, keep wages down, let everybody work. But this is the direction we're going.
Exactly. And just, again, we discussed it just as it's a good example of kind of how the economy works. And when people are hopeful, like, I hope, the days of getting the be able to feed a family of 4 at McDonald's for under $10.
That's
That's
one
gone.
person maybe you can feed
Exactly.
for $10 if you're lucky.
Right. But everything kind of, the key is hopefully everything moves up together.
Yep.
And so natural measured inflation is good for the economy. It's a sign of a healthy economy. It's certainly getting that, make sure it's measured, and make sure your workforce is able to have a standard of living. So,
Absolutely.
and so speaking of the workforce, speaking of the economy, I think it's a great segue, and you kind of hinted to it a little bit. How are, I guess this next discussion to be like perception versus reality. What's the feeling out there right now, and what are some of the data that
People
we're
are
seeing?
scared.
People are scared, right?
People are scared. And, there's a lot of things to be scared out there. The economy is not one of them right now. Of course, there's states that are not doing well in real estate. There's issues out there, but in a general economy, we're doing okay. We still have a problem with costs down at the, middle class, being able to go to the grocery store and be able to feed families. That's still an issue. And until, unemployment or wage growth goes up and, inflation stays down, and that gets a little bit better, that should help. But right now, people aren't feeling too good.
Yeah.
They're excited about the stock market, but they hear all these bad things out there. And, with unemployment going up a little bit, with open jobs shrinking, it's not a great direction. All right. And I can understand why people are feeling a little bit nervous.
Right. Yeah.
One of the things driving the market right now is your AI spending.
That's right.
So, if you're not in the AI world, the markets really aren't going up that high.
Right.
So, when you're just a normal person out there trying to make it through the day, you may not feel like you're getting ahead. And that's where confidence comes in.
Yeah, and confidence. Even the economy may be doing
It may be doing great.
but if you don't feel like it's doing great,
Right.
and people, it's almost a self-fulfilling prophecy.
Yep.
that people feel like it's not doing great,
Mhm.
so they slow down their spending, and then it actually creates some type of,
Yep.
of downturn.
And you know, the economy could be doing great, and actually earnings are coming out really good.
That's right, and we're
Okay.
going to look at that chart in a
Yeah,
second. Yeah.
earnings are coming out really good. But if you turn on the TV and watch any news show out
Right.
there, or turn on a podcast and listen to anything, you're going to hear some of the most horrific things you could hear, and it's just to scare you.
That's right. Yeah, yeah.
And if you just turn that off and go walking around downtown and see what kind of activities down there,
Mhm.
you might see that we do have a pretty robust economy.
Yeah.
People are actually out there doing stuff. Now, people don't have excess amount to spend. Maybe their debt's going up a little bit, but hang in there. That's going to get better.
Yeah, and I think we're seeing that data point here, in terms of how's the U.S. economy performing in terms of GDP growth, and so the numbers are still coming in pretty well, and so of course there's some stories still to be told, how the tariffs are ultimately going to play
Yep,
out,
yep.
and those types of things. But so far the data coming back, economy's actually still performing at a pretty good
Mhm.
clip. We're just seeing some of those little downturns in possibly consumer
and-
sentiment.
And that whole part of the tariffs in the beginning of the year, I always say, tariffs are a nothing burger. They never been. They weren't 8 years ago. They're not right now. Things seem to be going well. We're collecting more money. We're not in the red every month. We've got more money coming in, so our debt's not dramatically going up. So there's a lot of good things happening there. But the economy's doing well. Our
Yeah,
corporate
yeah,
earnings are doing
exactly.
well. Americans are very resilient to anything. They're going to go out to eat.
We're stubbornly
We
resilient.
we are. Even if you see confidence going down, even if you feel a little bit bad, it's going to
Right.
take you a little while
Right.
to kind of get
Yeah.
that out of your system. You know,
You might feel bad, but you're still
You're still
clicking
gonna go
that
spend.
buy button on Amazon.
that's right. Amazon's not going to stop until it has to
Right.
stop.
Wal-
right?
Walmart's crowded.
That's right.
I've been traveling a bunch. I was out on a Tuesday night and had trouble getting into a restaurant
Yeah,
recently.
it's
So
crazy. It really is.
Yeah.
And that's great. We need to continue this. Now, when things get bad, usually people start sitting on their wallets because they're afraid of something.
that's right.
Enjoy your life. Don't listen to the news. They'll scare you. Do what you've been doing and enjoy your life. Things are going to be okay.
Right. No, absolutely. And we've seen that in terms of GDP growth, and also where we see earnings trends as well.
Oh yeah.
Tends to be doing well. So kind of our last segment here, I wanted to get into some of the market risk that's out there right now. I think it's not breaking news to everybody that technology and AI have really been the headlines. Really, a lot of the growth driver
Mhm.
in the markets. It certainly, I think, accounts for about 38%
Yep.
of the value of the S&P. Really highly
Which is
concentrated
very highly
at the top
concentrated.
of the a few tenth stocks there.
Mhm.
But talk to us about the risk profile out there that's out there. Maybe what investors should be looking for, and is this train going to just keep lasting forever? As
Well,
it usually
I-
doesn't.
I don't have a crystal ball, but I've been in this business long enough to know that when investments out there start garnering everybody's money at
Right.
one time, you got to take a step back and say, why is that? All right. So let's first talk about AI. I heard Jeff Bezos bring out, and I agree with him. I think this is going to be a very good technology. I think the world's going to benefit from it, but I don't think the trillions of dollars going to it is necessary or needed. And if you take a look at the money, it's unbelievable how much Facebook, how much Google, how much Apple, all these companies are paying. Now, if you look at the darling of Wall Street, which is Nvidia, um, Nvidia sells chips, right? How many chips do you think we're going to need?
A lot.
But do you know the number?
I have no, I do not.
No idea. Do you know how much chips? You know how much? We don't know how many chips we're going to need,
Right.
but they're producing chips and they're selling them like they're going out of style. Well, what if people slow down their buying of chips? What's going to happen to this darling of Wall Street? It's going to go down.
Yes.
All right. So, how do they get around slow down in selling of the chips? Well, they make deals with people, and we call this secular investing. Okay, and this is pretty dangerous. What's happening is you'll notice that in September, on September 10th, Oracle's stock jumped 25%.
Yeah, I saw that.
It's a well-run company, but there's some problems there. Well, they went up 25% because of the fact that OpenAI, which is ChatGPT, promised them $60 billion a year for cloud computing facilities that have not been built yet. Does that, I mean, does that register?
Yeah, it
These
smells of late 90s.
facilities have not been built yet. Now, they were promised $60 billion a year, an amount of money that OpenAI doesn't earn, and they don't provide any of this stuff. So where did OpenAI get their money? Well, they got their money from NVIDIA. NVIDIA invested in OpenAI. OpenAI turned around and made a promise with Oracle. And on the flip side, Oracle made a promise to buy billions of dollars worth of chips from OpenAI. Every stock went up.
Yeah.
Every stock went up. And this is happening over and over again. Watch NVIDIA and the deals that they make. They just made one that made AMD. Now, these are deals for future purchases. This is not money really changing hands. It's perceived value.
Right.
Okay. So that's what I see going on right now, which is, in my opinion, it's pretty dangerous when you're dealing in that kind of stuff, because at some point in time, if the revenue is not there,
Right. This is
it's
all
going to come out.
project. Yeah.
So, there's some quotes I want that might help you understand why this is happening. So markets are often driven not by just objective reality, but by perception of reality. If you perceive something's right, then it's going to be right.
Sure.
Sometimes people believe in things that aren't true and act on it as if they are true. Okay. These perceptions of reality influences prices. Prices impact fundamentals. And then those affect fundamentals, now shape perceptions, rinse and repeat over and over again.
Right.
All right. So if OpenAI is going to pay Oracle for something that they have not already even developed, why did they go up 25%? It was just
Perception. Yeah.
Okay. And that's pretty dangerous. I think AI is here to stay, but right now you can't tell me what the ROI is on this investment.
Right. And certainly in certain particular companies, especially.
Right.
Yeah.
So if you own NVIDIA and they're making all these investments in these other companies, what's the return on investment?
Yeah.
Nobody can tell me what that is, because it's impossible to calculate, because we don't know where it's going. That's the problem. People are investing their money in a technology that has not been monetized. There's no ROI. That scares me. So, there is, when sectors alone get to be so big in the S&P 500,
Yeah.
and it's on something that's revolutionary, that is brand new, we don't know what's going to end up. Be very careful.
Right. Understand the risk profile you have in your portfolio,
Right.
and understand concentration in certain sectors, and just have a little awareness of what's going on out there, because nobody ever knows or predicts the next shoe to drop, and it happens fast, and you don't know if when it happens, like, oh, did the market just go down one day, or is this about to like fall apart? And so if you build your portfolio and your assets so that it does go down all of a sudden, you know what you're holding, you know why you own it, and you're balanced pretty well across different asset classes.
Yeah, I kind of look for dividend paying investments during these times, because they're usually the largest companies
Right.
out there. They return money to their investors. They're not out there speculating. So that's really where the safety is. If you got a big portfolio of this high flying stuff in AI, you may want to take a look at it and say, okay, maybe take some risk off and let's get a little less risky on it.
Yeah. Well, great. Well, Pete, I appreciate the insights as always, and certainly as we head into the fourth quarter coming up, we've got some. I'm sure there's going to be some headlines. Obviously, major peace deal that just happened in the Middle East, which is incredible. Hopefully that reshapes that region. We've got a couple more Fed meetings, I think, which will possibly shape what the direction of the U.S. economy. And so, as always, we'll be on top of everything.
Yes,
and
we will. But
keep everyone updated.
I'm going to make one prediction.
Oh, here we go.
I think the first quarter is going to be rocky.
Okay.
We might have a downturn in the first quarter just because.
I mean, it's been great.
I mean,
so.
yeah. And, first quarter, think people get back to work and Congress get back to work and they're going to start beating each other up again. People get scared. We're going to get some tweets. We're going to get some posts. We're going to get some. So we're just going to have to deal with that. But I don't see anything right now other than maybe, a tech bubble pop, but that shouldn't really affect the entire market.
Sure, sure.
I mean, I don't think a lot of people are going to be losing their jobs over that,
Right.
like we did, like we saw in the .com. But it could be pretty painful because as high as they are in the S&P, if they drop, the whole S&P.
Well, yeah, it's going to
Yep.
go down severely.
But it doesn't matter. Doesn't mean all your stocks are bad.
Not if you're properly diversified.
No, just the ones that are scary.
That's
right
right.
now.
We'll mark the tape. Come back here, rocky first quarter, and
Rocky
we'll
first
see.
quarter. I hope it doesn't happen, but it just seems to always happen when we got a little bit of friction in government.
Sure. And tune into our YouTube channel or anywhere else where you get your podcast for other additional educational content. We've got a lot of things rolling out here in 2025. Thanks again for watching. And if you'd like to contact us, feel free at info@cpsinvest.com, as well as 863-688-1725. And look forward to doing this again soon. Thanks again. Bye.